When you're entering the market and you don't have a lot of money, I mean, you can probably find a warehouse for $500,000, but it's not going to be a very good one. If you have a portfolio of residential and you think, I would like to go into commercial property as well, that's a good diversification. It's part of that stepping up. If you had a commercial property, say in the COVID period, and your tenant can't pay any rent, well, you get nothing. There's nothing coming in. It's really hard to manage a whole bunch of houses. And if you go way up the scope, $20 million worth of property or $50 million worth of property, buying individual homes, no one really does that. The benefit for the small investor in buying the residential is the banks will lend you more, and capital growth is shielded from tax. Welcome to the Passive Property Investor Podcast, where I teach you how to stop trading your time for money with property investment. I'm Jerry Parker, your property investment consultant. Let's dive in. Hey, you're back with Jerry Parker again on the Passive Property Investor Podcast. Today, I'm going to look into the difference between investing in residential properties and commercial properties. Fortunately, I own both, and I've owned both for many, many years, and there is quite a big difference in the two. Which one I prefer? I don't know. They balance each other out. Commercial properties are like this. You get higher rental yields, probably about 2 or 3% higher than, or more, higher than a residential property. But say like it's a warehouse, for instance, where you have one tenant. And if that tenant leaves, it might sit there vacant for 6 months before you get another tenant. But the tenant pays the rent and all the outgoing. So it's just net income coming in. And there's never much repairs and maintenance like in a house. But you get high cash flow, high income. Another aspect with commercial would be that if you have more money, you can buy one property that costs a lot more and get high rental income. So from a management point of view, you know, it's really hard to manage a whole bunch of houses. And if you go way up the scope, like if you're buying $20 million worth of property or $50 million worth of property, buying individual homes, that's very hard. It's very hard to manage, and no one really does that. They would go into the commercial market. So in some instance, when you grow up financially, you start moving into the commercial market because you have more money and it becomes a management issue. It's like I can buy the commercial property and I can invest more, quantum of dollars. There's some negatives with commercial too. Like I said, that rental vacancy rate, and it's their values are more sensitive to interest rates as well. It's because there's no emotion driven in it, and it's just based on the return. And so, as interest rates goes up, commercial properties go down in value. And if interest rates drop, commercial properties go up in value. Those are just some of the investment about commercial. Now we'll talk about residential. Okay, residential properties get lower rental return, from like 3% to 5 or 6%. And then you get the jewel key type properties. You're trying to get a little bit more. There's a management with each property. So there's small lots of money that require management on each one. There's higher, say, repairs and maintenance on there. Both of them, you get depreciation, but you can get more depreciation in a residential property for the first 5 years. And the government's kind of trying to get rid of that too, but it probably won't work. The benefit for the small investor in buying the residential is the banks will lend you more. They'll lend you with a lender's mortgage insurance 90% or 80% quite easily. Whereas in the commercial market, it's the LVR, they're aiming at 60% and kind of maxing out there, whereas, the residential get 80%. So you can't borrow as much. And another great thing about residential property is the capital growth. Commercial, you have to wait for interest rates to drop really low before there's any capital growth, and there's not as much. But in the residential, because of the shortages of housing, this endemic in Australia, you get big capital growth. And capital growth is shielded from tax. You don't pay tax on that until you sell the property. So you have a shield and it can keep growing. And so for a smaller investor, residential is ideal to help you build your portfolio. Some people want to move over and get commercial, but you're moving into a different risk parameter as well. Like, for instance, I have some commercial properties that I built myself. It's a Bow Repairs Tire Center. It's in a great location. The rental yield I don't know, I think it's like 15% now, but it's very high rental yield, but it's a purpose-built building for tire fitting. And if this tenant moves out, like who's going to want a tire fitting? I can only get a tire fitter or have to redevelop the whole property or do some substantial work on there. That's pretty risky. So every time the lease comes up, I'm kind of like, oh God, like, well, what am I going to have to do here now? I hope I have enough money to deal with this. And luckily mine, they've all stayed there, but eventually this is what's going to happen. And so it's risky. You get good cash flow. You'll make money fast with the residential because of the capital growth. Negatives on residential is the management cost, and a tenant can tear up your property, which can be quite expensive. The repairs and maintenance is costing more. From a management point of view, the residential, having a whole bunch of small residential properties is more expensive and time consuming. With residential, you'll get 5% rental return. Pretty consistent, but then you'll also get 7% capital growth a year. So that's 13%. With commercial, at the moment, commercial yields, so for you to go and buy a good property with a long lease on it, they're about 5%. So they're fairly low at the moment. So with residential, you'll get about 13% if you include the capital growth and the rental income. With the commercial, the capital growth is less. It's probably 2%, 3% a year maximum. So I think residential is a better investment for the moment, and especially for smaller investors. Yeah, if you're buying for the first time, it would be residential, because unless you can handle a 6-month vacancy rate. And here's the thing. When you're entering the market and you don't have a lot of money, I mean, you can probably find a warehouse for $500,000, but it's not going to be a very good one. And it's going to have a transient type of tenancy where you'll have vacancies in there, and they'll probably clock in with 2 years or 3-year fixed term, and then you'll have a vacancy. It's too much volatility for the first investor. I would much suggest going with the capital growth from a residential investment and then purchase at a price where you get cash flow positive. So if you have a portfolio of residential and you think, I would like to go into commercial property as well, that's a good diversification. It's a good strategy. I wouldn't sell, unless in your portfolio you need to sell one. Sometimes properties, they're not going to go up in value anymore. There's no depreciation, and the location is going down. You could sell one and then buy some commercial property. It's part of that stepping up. The steps you take are cash flow, gives you the ability to borrow more money from the bank and afford interest payments. And then you buy the asset, and then the asset goes up in value. And then you increase your cash flow. Then you can buy another asset. So it's like taking steps that go up to your wealth. And an income booster for that portfolio can be a commercial property. So I do think it's a good way to diversify. And I have a diversified portfolio in that fashion. I've got 2 commercial properties in my portfolios. From an external risk point of view, the commercial property, like say in the COVID period, if you had a commercial property and your tenant can't pay any rent, well, you get nothing. There's nothing coming in. You can just be at a zero rental coming in, and you might not know how long that lasts for, which could be fatal. But with the residential, someone will always rent it because there's a shortage and people need a place to live. And there's a lot of people, but not everyone needs a warehouse or that shop and that shop. And you drive by, you see them, they stay vacant for months. And that's the risk component with commercial. And if you're a new investor as well, there's grants you can get, like the first homeowner grant. So that can help you become a rent investor. You go buy your first home, you have to live there for 6 months, but then you can move out and turn it into an investment property. There's nothing like that for commercial. You're kind of pretty much on your own. And in fact, this is what you'll be up against. Say like if it goes vacant and then you get a tenant coming in, it's been sitting there for 3 months, you get a tenant coming in and they want you to do their fit out for them. And then you go like, well, I won't go in there unless you pay for the fit out. So now you might have to do a $50,000 fit out for this tenant. And you can write it off on your taxes, but you have to, it's not for the smaller investor. You have to oh yeah, I'll do the fit out. I get to write it off on my taxes, and you have this tax problem that you have this need for. But if you're just starting out as a small investor, there's too many fatal things that can just tip you off. That's why I wouldn't suggest it as your first few investments. You need to have it's more of a commercial, application where you need a bit more equity or more money behind you. So to wrap this up, focus on residential at the beginning. If you're a passive investor and this strategy you're using, you're going to go into, after 4 or 5 properties, you can look at some commercial, but build your personal portfolio with residential and solve this. You got to always remember there's 2 problems we're solving. One of them is your taxes, and the other one is that lazy equity in your house. Solve those problems with your early portfolio first before you go into the commercial properties, before you go into setting up trusts to buy those, or companies to buy those, or super funds to buy those. Let's just solve these 2 problems. If you want to talk to me some more, feel free. You can check the links down below, and you can book a strategy call with me. I got a Facebook page. I got a YouTube. Make a comment on that. I'll monitor it all. I'll come back to you. I'll happily see what I can do to help you out. Look forward to talking to you again. Cheers. Thanks for tuning in to The Passive Property Investor. If you enjoyed this episode, the best way to show your support is to give a 5-star review on Apple Podcasts and Spotify. Make sure you subscribe to the YouTube so you don't miss a single episode. We're on all social media platforms, so feel free to connect with me there. And if you're having specific problems making your first investment or building your portfolio, maybe you don't know which location to invest in, how much you should invest, you're worried about who to trust, reach out for me down below. I will have the answers for you. Don't hesitate. See you on the next episode.